Hello everyone, Vernon McCarty here, the Financial Makeover Specialist, working with people to create power and freedom in their finances and in their lives. Today I'm making this video to talk to you a little bit about some insurance options that are available to you out there. We're going to compare mortgage insurance to personally owned life insurance, okay? And I'm going to tell you some of the benefits of how they both work, and you get to choose what works best for you. So first of all, let's talk about ownership. When you go to the bank or to your broker or whoever it is and you sit down and you talk to them about getting a mortgage, they're going to ask you if you want to have mortgage life insurance on your mortgage, okay? Now, you get that with credit cards, you get that with lines of credit. It's all, in my opinion, it's all junk and it's all profit for the banks and for those lending companies. And I'm going to show you exactly what I mean by that. Ownership of the contract is very important. When you sign that contract, what actually happens is the bank is actually the owner of the contract. And they're also the beneficiary of the death benefit, the beneficiary of the contract. So that means if your policy actually pays out with the bank, if someone dies, that the money is going to go directly to the bank to pay off the balance of the mortgage, and your family or your beneficiaries have no choice what happens to that money. Whereas with personally owned insurance, your family or your beneficiaries get the death benefit. They get the they get the benefits, and they get to choose what they want to do. Do they want to take a vacation? Do they want to just grieve for a while? They want to, they don't have to worry about money in that heightened state of emotion when they're stressed out. They can just choose what they want to do. Should they pay off the balance of the mortgage? If that serves them best, they get to choose that. Maybe they want to invest the money and live off the interest because they can handle the mortgage payment. We're not sure, but you have that opportunity with personally owned insurance where you don't actually have that with mortgage insurance. Let's talk a little bit about how you actually qualify for mortgage insurance versus personal insurance and why personal insurance is actually a safer bet. Normally what happens is you're going to sit down with your mortgage advisor or wherever they are, and they're going to ask you a few maybe health questions generally, and you're going to answer those questions yes or no, and if you qualify, great, you get the coverage. But ultimately when it comes to claim time, if somebody dies, that's when they're actually going to do the investigation into the person's medical history. And if they can find a reason why you wouldn't have qualified at the time that you applied, that means the benefit is actually not going to pay out. And I know that sounds a little bit crazy, and it also sounds like it probably should be illegal, because that's what a lot of people have said to me. They're like, wait a minute, that doesn't make a lot of sense. You're telling me that if someone dies, that's when we're going to find out if it's actually going to pay? So it's not actually a guaranteed thing, because it's not underwritten at the time of application. It's underwritten at the time of claim. Whereas with personally owned insurance, typically you're gonna give some blood, you're gonna give some urine, you're gonna answer some medical questions, and generally they are going to check in with your doctor and get your medical record as well. So the insurance company has a really good idea of what your health history is and what your health condition is today. And then they're gonna give you a contract that guarantees that the money will pay if someone dies should you get approved, okay? So it's a much more bulletproof approval process with personally owned insurance. Let's talk a little bit about cost. Generally, personally owned insurance, if we're talking term insurance, my last video talked a little bit about term insurance and how that works, and I'll do more videos that talk about how insurance actually works and how it can benefit you, not just if you die, but also while you're alive. But for right now, we're going to talk about term insurance versus bank insurance, and generally, personal insurance on the term side is less expensive than what you would pay at the bank. There's also something that's really important here. On the personal side, you might apply for $1 million of insurance because you want to cover the mortgage and a little bit of income protection there, okay? Well, on the mortgage side, you're only going to be covering your mortgage, which might be, let's say, $500,000. Now, even though there's a lot of interest on your mortgage, every time you make a mortgage payment, this amount that you owe is going to go down. But the cost that you pay for insurance stays level, it stays the same. So the benefit that they're going to pay you is actually dropping off as you pay your mortgage. So you're paying the same cost, okay? The cost doesn't change, but the benefit actually goes down as you pay your mortgage. Whereas on the insurance side, even if you pay your mortgage off and you still have the policy, you're still covered for $1 million, which can protect you for retirement planning, okay? Now, at the end of the day, ultimately, personally owned insurance simply gives you and your family more options. So if you like to have options, you like to have more control over what's going to happen to you in your future, I recommend that you go with personal insurance, and make sure you talk to a good insurance advisor who can help you make the right choice for you and your family. And I'd be happy to support you with that. If you have questions, reach out to me. Please like this video, share it with your friends, and subscribe to my YouTube channel if you want to hear some more great content. Have a great week. Talk to you soon.